Hello everyone, how are you all? I'm Dr. Labib from Dr. Labib Academy. This is my YouTube channel. Today we are going to discuss about F7 financial reporting with respect to IAS 12 income tax. This is a scenario based question which you are going to work it out. What is the basic concepts of IAS 12 and how it is related and how it is applied. I request you all to see this channel till the end and hope you subscribe to this channel so that whenever I post new videos you can get the notification and it will help you in your examinations. In this YouTube channel, a brief overview about this. We are going to have F7 financial reporting, F8 audit and assurance, and from the professional level SBR, strategic business reporting. Okay, so you see till the end. It's very comprehensive, very short video of 30 to 35 minutes. And it will really help you how we can go further. Is it? Now, let's start. What we are going to work it out today in this session. Is it? We are talking in terms of IAS 12. Before we go to this question, is it right? This question talks about the carrying amount of Julian property, plant and equipment. 31st December is this much. They are talking about something in terms of what? They are talking in terms of something with us, taxes. Yeah, and that's what it says. They are giving you two scenarios, is it? They are giving you two scenarios. Based on the scenarios, they have given you some questions for 10 marks. It is section B. Fine, it is section B. Before we go, we going to solve. Should have a brief overview about the taxes and what is the basic concepts and how it has to be worked it out. Already I have uploaded this video. If you want, first you go through this video, the theoretical concepts, then you start working on the examination based questions. Is it right? This will be very helpful. Fine. Now I will just go through. I will take a few minutes of mine to explain you what is the taxation concept of taxation in the account for income taxes in accordance with IAS 12. How we are going to record the entries of income taxes. We have done in income statement, profit before interest and tax, minus interest, profit before tax, and then tax. And apart from that, in the balance sheet also, in the current liabilities, we have shown taxation. Is it? We have shown taxation. Means how it is going to be related, both the things. And most importantly, here we are doing for the first time we are doing something with respect to what? Temporary difference. There will be a difference, is it right? There will be a difference because what happens when you are talking about the difference, there will be how much you have to pay payable. We are making a provision. And definitely we will pay. This is what provision is nothing but we are talking in terms of an estimate. We will make an estimate of payment of a taxes because taxes will be paid in the next year, is it? If it is for December 2022 for the reporting period of 2022, December 2020, January to December 2022, then the taxes will be paid in the next year. But in the financial statements, we'll make a provision. And sometimes we'll pay tax in advance also. When we reconcile it, definitely there will be some temporary difference. And in terms of what is the taxable profit, calculate and record the deferred tax. Deferred tax is nothing but what is the tax going to be paid in the forthcoming period as such. A quick revision, a quick recap. Please go through this. We are talking in terms of current tax, how much you are going to pay in the current period. A deferred tax, an accounting adjustment aimed to match the tax effects of transaction to the relevant accounting period. I'm using a different ink for you to make you understand. Yeah. That's what it says. Means you will have two things. One is current tax and one is deferred tax. We will cover basically we have debit income tax is an expenses, and credit is provision, current liability. Whenever we are talking about the liabilities, we'll show a credit balance. Whenever we want to increase the liabilities, we have to credit the liability account. Tax payable is a current liability. We have sometimes we'll have under provision, we have over provision. When it is a under provision, means we have provided a lesser provision, it increases the tax charge. Sometimes it is a over provision, we have the tax charge will decrease. A small example I have done here, and just I am going through the concepts before we work it. What is the deferred tax? Make it a point. They will ask you somewhere in the MCQ. Both they will ask you in section A as well as in section B. Okay, so I am putting one asterisk mark here. When I am putting an asterisk mark with a purple color, it means it is we have to be very specific on that. What is the deferred tax? The estimated future tax. Okay, the future tax consequences of transactions recognized in the financial statements with respect to current and the previous periods. What is the future tax consequences? How much we have with respect to the current period and with respect to the previous period. See, basically the deferred taxation is the allocation charges for a particular. We will calculate the tax, but we will defer it for a further period. The concept, it says that the accounting profit is the figure of profit before tax. That's for profit before interest and tax reported to the shareholder. We have that concept as profit before interest and tax. Profit before tax, then you will pay tax. Definitely there will be some adjustments that will happen. Either you will make an over provision or you will make an under provision. Till now, if I remember correctly, definitely we are going to make a under provision, and subsequently we will have its impact. The difference between an accounting profit and taxable profit is by what? In some cases it will be permanent differences, it will be temporary differences. Permanent differences we are not going to have that much, but we are very much concerned about the temporary differences. Previous year amounts settle in the current year. We cannot carry forward. Any differences is there, it has to be settled in the immediately next accounting year. The fundamental principle, what rule says. See, these are important concepts to solve both section A and section B. And somewhere in section C, they will ask one element for 2 or 3 marks. An entity should recognize a deferred tax whenever the recovery or settlement of the amount of an asset and liability would have a future tax payments. Larger or smaller, is it? If it is not like that, it means when we say it's a deferred tax liability, it will happen. What are its implications in the coming accounting periods as such. When we are talking about the deferred tax is a liability method. We have to pay, which is deferred by calculating the tax base. First time you are called thinking something about what? We are discussing something about it is a tax base. What is the tax base? Tax base is nothing but a total value. Is it a total value of asset? Is a total value of asset, total value of a proper property, plant and equipment, or total value of the income. Is it total value of what is the importance of it? Tax base is nothing but the value, is it? When we say it is a tax liability, tax liability is nothing but tax base times tax rate. The tax base times tax rate as such. And carrying amount is the value which we are going to show it in the financial statements. Okay, this is the basic concepts. We have that. Definitely if it is increase, we have to credit the tax because it is a liability. And the credit side, if you want to increase the liability, it has to be done on the credit side. If there is any reduction in the liability, we have to do in the debit side. That's a simple. It's a very specific one. The deferred tax assets and deductible tax temporary difference arises when the tax base is how much. Here this is when there will be a temporary difference. Tax base is 160, carrying amount is how much? 140. You have a temporary difference of 20,000. Whenever the tax base is more and carrying amount is less, there will be a element of temporary difference. This temporary difference is a very, very important concept, especially in section A and section B. Especially the deferred tax is recognized for all deductible differences, because whenever there will be a temporary difference, definitely we cannot avoid tax. We cannot avoid tax, and it is probably that the taxable profit will be available for calculating the temporary difference. This is a basic understand. A deferred tax arises when the entity making losses previously. Whenever there will be losses, definitely on the losses we are not supposed to pay taxes. The entity must be able to demonstrate sufficient forecasted profits in order to utilize for the assets. This is where we are talking in terms of deferred taxation. Two things we have to take. There is a temporary difference, tax base, and more importantly, we are having a deferred taxation. These three concepts are very, very specific. What are deferred tax liability? Recognized for all taxable differences. There are some minor exceptions are there. What the most important point is, a taxable temporary difference arises when the carrying amount is greater than its tax base. Whenever there will be a difference between the tax base and the carrying amount, then what will happen? There will be a temporary difference will be there. What happens when the second part, the revaluation? We will revalue the non-current assets. Whenever we revalue the non-current assets, there will be a temporary difference. It says that the difference between the carrying amount and the revalued asset and its tax base. Here we are adding three different elements. The first one is the tax base, the second one is the carrying amount, the second one is the carrying amount, the third one is the revalued amount. The third one is the revalued amount. Whenever the difference is that the difference between carrying amount, the difference between the carrying amount and the revalued amount. Most of the time the carrying amount, for example, taken it as an example, carrying amount is 20,000 and the revalued amount is 22,000. That the temporary difference will be how much? 2,000. And for 2,000 we have to pay the tax on the current rate, only on the difference. This is one of the examples. You can refer this in another video. I have been posted specifically on taxation. Okay. This is a brief overview about the taxation concepts. Now coming to the scenario based question. It is for 10 marks. See, the rule says that the 5 questions, the concept, the experience says that they will ask you a theoretical question, they will ask you an application, they will ask you a calculation. Okay. There are 3 different, usually this is my assumption, my understanding and my experience. The carrying amount of a Julian company's property, plant and equipment is how much? 3. This is the carrying amount. This is the carrying amount. Carrying amount is how much? Carrying amount is 310. How much is the carrying amount? Is 310. And what is the they have tax return down value after paying the carrying amount of Julian's property, plant user was 300. And what is the tax return down value? Return down value is how much? Tax return down value is 230. Fine. Put one dash here. Put one dash. I will change the color for your understanding. Okay. The following data relates to the year ended 31st December 2004. At the end of the year, the carrying amount is how much? When it is there on 31st December 2004. The carrying amount is how much? The carrying amount is, this is when this is happening on 31st December 2003. 31st December 2004 is how much? It is the carrying amount is 460,000 and return on tax return down value is how much? Tax return down value is 270. During the year, some years some items have revalued. How much is the revaluation? Revaluation has done by how much? Revaluation has done by 90,000. No items have previously required revaluation. In the tax jurisdiction in which Julian operates, revaluation of assets do not affect the tax base of an asset or taxable profit. Means in the country in which Julian operates, tax jurisdictions, they will not have any taxes, gains due to revaluations does not affect the tax base on the assets or taxable. Gains due to revaluations are taxable on sale. When you sell property, then only that amount will be taxable. Right? Julian began development a new product during the year, capitalized how much? 60,000 in accordance with IAS 38. Research and development. I'm just going, I'm just making a small reference on that. Fine. Research, research expenses, research and development. Development is to be going to be capitalized. Development expenditure has to be there. Research expenditure should be expensed. Is that? This is the very simple concept with respect to IAS, research and development. None of the expenditure has been amortized. None of the expenditure has been amortized by the year. Amortization is done basically on intangible assets or loans. Right? If you are taking the loan, then you are paying the things. Basically, if you take into consideration, it will be based on what? It will be based on intangible assets. What they said? They say it's a corporate tax rate is how much? 30%. Take your time. I'm very slow making it so that you can understand. Julian accountant is confused with the term of tax base. See the things. They are asking you a basic fundamental question. What do you mean by tax base? Yeah, what do you mean by a tax base? What is the tax base? What we have done? Tax base is nothing but the amount of the asset, property, plant and equipment income. Is it? Here what happened? The amount of tax payable. See everything. See what happened? The amount of tax payable is, what is the formula for this? Tax payable is nothing but tax base. Is it? Tax base times tax rate. Is it? This is not a tax. This is it. The amount of tax payable is nothing but tax base into tax. The tax regime under which an entity is assessed, it is a regime. Is it? We are not talking about that. We are talking about what is the base, what is the value. Again, we are not talking about the tax regime when we are going to assess. The amount attributed to an asset or liability for tax purpose. Here they have mentioned very clearly the amount. They have mentioned very clearly the amount. The amount of tax deductible. We are not talking about the tax deductible in the future period. This is with respect to what? This is with respect to tax base. And this is very important concept whenever we are talking in terms of what is the concept of a tax base. Next, use a drag and drop option below. Show the taxable temporary difference to be accounted for 31st December 2000 in relation to property, plant, equipment and development. They are talking about two things, is that what is the property, plant and equipment and development expenditure. Any doubts are there, just to post it in the comment section, and I'm reviewing the things on a continuous basis, and if there is any possibility you can, otherwise you can send me email by drlabib@outlook.com. I will be there. I will reply those to these emails also. Fine. Now, what is the property and plant and equipment? How much is the property and plant and equipment? Property, plant and equipment is how much? 460. How much is there? We just go back. How much is the 460? And how much is the written down value? 270. How much is the return? This is, we will write here, property and 460 is the carrying amount, and how much is the written down value? 270. If we take the difference here, is it right? If I take the difference here, this is going to be a temporary difference. Temporary difference for what? Temporary difference for property, plant and temporary difference for property, plant and taxable temporary difference. Now, what is the development expenditure they have mentioned? They have mentioned a development capitalized is how much? Development expenditure is 60,000. Okay, development expenditure, how much they have capitalized? Development expenditure capitalized is how much? 60,000. Okay. Development expenditure how much? This is going to be 190,000. This is going to be 190,000 and development expenditure will be 60,000. Okay. Now, what amount should be charged to the revaluation surplus? Yeah, what amount should be charged to the revaluation surplus at 31st December 2004 in respect to what? In respect to deferred tax. Now, how much is the revaluation surplus? Fine. How much is the revaluation surplus? They have mentioned here very clearly that during the year, some items were revalued by how much? Some values have revalued by 90,000. And what is the tax rate? Tax rate is 30%. This is what we have done, is it? This is what we have done. Now, revalued amount is how much? Revalued amount is 90,000. Tax rate is how much? Tax rate is 30%. Deferred tax is revalued amount times tax rate. Revalued amount times tax. 90,000 0.3, it comes to how much? It comes to 27,000. Okay, it comes to how much? 27,000. Okay. Select your answer from the next one. Select your answer from the options below. Which amount will be shown as a tax payable? How much is the amount we are going to show as a tax payable? They have mentioned here, we don't need to do anything, is it? Then we don't need to do anything. How much is the amount? The current tax charge. I am giving another color to this. The current tax charge as calculated for the year is how much? For the year is 45,000. How much is the current charge they have to do? We have to make it how much? It has to be 45,000. Okay, next. What has been given? Fine. This is the last question in this scenario in IAS 12. IAS. Now you can have a clear picture. Just go through it, read one, revise once, twice, thrice. Concept will be more clear for you. Deferred tax assets and liabilities arises from taxable and tax deductible temporary differences. That's good. Which of the following is not a circumstances given a temporary difference? Which is not? Means out of these four, you have three are the circumstances and one is not a circumstance. If you understand each point, automatically you will understand the entire concepts also. Depreciation accelerated for tax purpose. Fine. You see what will happen. You are charging depreciation how much? 20%. Now you will charge depreciation by 25%. Depreciation is depreciation rate of depreciation is increased. Rate of depreciation increases, what will happen? See the thing. If the rate of depreciation will increase, your expenses will increase and your profits will decrease. Okay? Yeah. Automatically what will happen? There will be a temporary difference. This is the source of temporary difference. This will have the temporary difference. Development cost amortized in profit and loss account, but tax was deductible in full. There are inconsistencies actually. When the temporary difference will come, whenever there is a inconsistency. The moment there is a inconsistency from year to year, year to year, automatically what will happen? The temporary difference will come. If there is if there is a consistency, there is no temporary difference. Here also what happened? One, development cost amortized in profit and loss account, but they have not done in the tax in full when it has been incurred. Again, this is what happened. This is the source of temporary difference. Accrued expenses which has already been deducted for tax purpose. You have deducted any you have deducted expenses and we are not having any adjustments. This is only one standalone variable, standalone value. We don't have any other thing. Next, we'll come to the next one. Revenue included in accounting profit when invoiced, but only liable for tax when cash is received. Again, they see when revenue included in accounting profit, when it is accounting profit, definitely that will be a part of the tax based. Now, here what happened? You cannot say that when I will receive my cash, I will pay profit. I will pay my tax. When I receive my cash, I will pay. When I receive my cash, I will pay the tax. No, we should not. We have to make. There is a inconsistency. Means again, this is going to be a source for temporary difference. What is not a source of temporary difference? The depreciation, accrued expenses which have already been deducted for tax purpose. The answer is this one. Okay, this is a very clear. You refer both the videos, the one which has been for the tax IAS 12, and you covered this one, and subsequently in future also, whenever I am going to post the videos, you will find it related to this. Basically, the basic concepts. What we have done with respect to the tax based, we have done with respect to the deferred tax, we have done with respect to the temporary difference. Okay, thank you so much. This is for today, and subscribe the channel, and if you find really interesting, write your comments, and in the end like it, so that it gives us a push to work on these areas. Okay, any opinion, your suggestions, any comment, you can post it in the comment section, and hopefully it will work. Okay, subscribe the channel and support the channel. Thank you so much.